All right. So I think start time is done. So we start. So today's session is on market cycles and how to strategize with a focus on small caps, mid caps, and how to create a portfolio. So we'll start off with the topic. So let me introduce you to me and Harsh. So this is Nuresh Mirani. I've been in the markets for the last. I've been tracking markets from 2004, writing on the blog nureshtech.co.in from 2005. Been in markets full time from January 2007 till date. I do multiple things. I'm a registered research analyst. So before we start, I would like to first give a disclosure that this is the me and my family associates analysts may have exposure to the stocks which will be discussed at the end of the session. We do not have any financial interest or beneficial ownership of more than 1%. And rest you can read through the disclosure. Please do your own research and take your own decisions. So let me start off with the topic itself, how to strategize across market cycles and the current market view and investing sectors. So this is a presentation done by me and Harsh Doshi, who's my teammate. He's also there on the webinar. He works on the background more than on the front end. Now, when we talk about market cycles, what is the biggest risk we all fear in the markets, right? It is more a fear of a bear market when the markets collapse 20, 30, 40, 50, 60%. And that is the biggest fear. Say, we do not fear a bull market or a sideways market as such. What is generally scary for every investor or a trader is a sharp fall in quick time. So that's the reason we are doing this presentation, which is where we try to analyze what are the types of bear market and how you can strategize yourself and actually come up making returns in some of them and saving yourself from the major corrections. So now there are three ways you can look at a bear market. The first one is the brutal bear market, which is extremely tough. Second is what we call as a time correction bear market. And third is what we call as the sideways market. Now, what we do in this case is we try to understand the various three market corrections. So let us start one by one. Now, the bear market, the brutal bear market. Now, this is tough because in this benchmark indices fall almost 40 to 60%. And the small cap indices fall 50 to 75%. Now, which are these markets which are comparable? So the Harshad Mehta fall in 1992, the 2000 fall, and the 2008 fall in 2018 to 20. Now, when I say 2018 to 20, it is because we were already in a bear market between 2018 to 19 for the broader markets. And then we got the COVID correction, which led to a sharp fall of 40% in less than a couple of months. Now, these are the markets which are scary. Now, what do you notice in these markets is, apart from 2018 to 20, every other brutal bear market was preceded by a big bull market. So Harshad Mehta time was a bull market. Ketan Parekh, there was a Y2K boom. 2008, there was a global boom in 2004 to 7. But 2018 was a little different. We had a very slow run in 2014 to 17 relatively. And 18 to 19, we were already in a bear market. Now, what to do in a brutal bear market? How do you save yourself? Do not over leverage. So the only way you can lose a lot of capital in the market is by leveraging. So I have a statement which says the retail investor loses while leveraging or averaging. So that is the next one, not averaging. So the biggest mistakes happen in terms of either going over leverage. So a small drop can actually multiply your drawdown by 3x, 4x, or by averaging. Now, the classic example of averaging right now is Yes Bank has 50 lakh shareholders. We have 11 crore demat accounts. 1 out of 20 shareholders is into Yes Bank, right? Now, this is considered to be a bigger problem for retail. They want to keep averaging or buy single double-digit stocks. So do not average on the way down. So because what happens in a bear market is stocks which fall in that bear market do not come back. So the leadership changes. So a lot of stocks will, like infrastructure stocks which fell in 2008, actually got delisted over a period of time or went to zero. So do not over leverage, do not average. Now, the next case is to increase cash, and sitting on it is a solution. Now, if you are able to catch the downtrend at some point of time in between or right at the top, whatever cash you have increased, all you need to do is sit, which is difficult. We'll try to see it. Now, for traders, it's difficult to short because of the recent history of bull market. Say between 2004 to 2007, if you made all your money on the long side, how do you go short easily? Right? So it's difficult. And also to short, it is that 50 to 150 stocks or the index. And bear markets have very quick bear rallies as well. So it's easier said than done. Now, the problem with a brutal bear market is, even if you save yourself from the market correction, you'll get hit in one way or the other. So your investments will go down, your trading will take hit, or other your business, job, etc. Because the economy is taking a hit. So you get hit in various ways, right? The same way, what we have to do is we have to be able to survive and do not try to make a killing. So you don't want to get killed or not make a killing in a bear market. It is difficult to be optimistic at the end of it. But the fact is, the bottoming out is fast and furious in such markets. So if you go back to 1994, 2010, 2021, you are back to highs in no times. So the general mistake is losing hope, mental capital, and optimism, because by end of it, you have lost hope on the markets. Now, how to identify a brutal bear market? So generally what happens is the first stage is there's a huge market rally, which has continued. And then in the end of the rally, you see small caps going berserk. So we look at this topic called small cap divergences to the index. I've covered it in detail on a YouTube video where we talk about how to trade small caps and mid caps across cycles. So basically what happens, you have a 10% move on the index and there's a 30-40% move on the BSE small cap index. The BSE small cap index, which is what I call as a index, which is the Kachra index of India, because it is on the bottom 15% of the market. So when you see such huge divergence, that is where you get an idea. But the fact is, you cannot go from 100% invested or 120% invested to 0%, right? So you can go to a cash of 10, 20, 40, 50% on this, but you'll still take a hit on the rest of the portfolio. That's a fact, right? But it will save you. You will be able to survive. And whatever cash you have in the bottom of the markets, you'll deploy into fresh ideas, into fresh leadership, which will do much, much better than the markets. Now, let us take examples via chart. So that gives you a good, say, when you look at the chart and the price correction, it will give you the extent of the bear market, even if you've not been there in the markets. So history is a great learning, right? When I talk about history, because when we talk about technical analysis, it's a study of history. So what happened in the past, a similar thing will happen. It may not be exactly same. So let us look at the first big bear market which Indian market saw, which was in 1992. Now look at the index. It went from 1,000 to 4,500 in less than a year and a half, right? Now that sort of move cannot happen so easily. That was the Harshad Mehta top. Going back from the 1979, 1980 index, although Sensex started in 1986, the index went from 100 to 4,500. Now that was a huge bull market. Even if you were to take it just the 1991, 1992 mark, that's like 4x in less than 2 years. Now, this is the period of time which actually, I'll go a little bit off topic here, but this is that 40x return, which is shown in a lot of AMCs, where they say the long-term return of India is 15, 17%. But you're not going to get a 40x move ever again in your career, in your lifetime, right? So mutual fund returns would be closer to 1.3 to 1.5x the fixed income returns. So if you expect 15, 18, 20% out of mutual funds, you have a wrong expectations, because that long-term return has this period of time between 1980s to 90s where the index construction is wrong, where there was a bull market which was crazy, which may not happen again. Now, after this correction, we went from 4540 to 1980. This was a drop of 55%. But what is interesting is Sensex went back to the same But still, in the last 1 year, in that period, the index went up from 800 to 1800. So you went up 120%, and then you fell off 55%, 53, 55%. The recovery was there, but then it took a longer time. Then we go to 2008. Now, this is where we saw this huge divergence. So this is the divergence which I talk about. We've discussed it multiple times. So look at it. The index is struggling at 5,700 to 6,000. There are 3-4 tops. But in that period of last 3-4 months, the small cap index has gone from 8,800 to 14,200. Now that's a huge 3x outperformance. So when you see that slope very, very different, where the major index Nifty is struggling, but the small cap index is flying up, that's the time we say this is too much. This is euphoria, and it lasts weeks and months. It is not something which will last for a week only. So it gives you enough time to reduce your exposure. Stop putting in new money. So even if you have not put new money in that period, that itself will be a savior, because that cash will be available for you by the end of the next cycle. Now, what happens in this case? Look at the return between 2004 to 7. We've gone up almost 3x, 4x. I remember in that bull market, after making a new high, Sensex went from 7,000 to 21,000. From the lows of 3,000 in 2003, it went up to 21,000. So it is a return of 3x to 7x from different points between 2003 to 7. And then we saw a 60-65% drop on the Nifty. But look at the recovery. You've gone up from 2,200, 2,500 to back to 6,300 by 2010. So the recoveries are also furious. But the problem is, by end of this cycle, you've lost hope. But this is the problem. The small cap index fell by 80%. Right? Now, this is where the problem is. This is what is scary. Even though the index fell 65%, the small caps fell 80%. The worst part is, if you have gone into the hyped sector, you will not recover money even after 10 years. So that's why not to average. So for example, if you averaged a lot of R Power, Reliance Energy, Lanco Infra, various infra companies, you will still not make money even 15 years out. So that's the reason I say do not average on the way down in the bear market. All right. Now look at this recovery also. It was decent even in the small cap index. Then 2018 to 20 was a difficult bear market, brutal bear market, in the sense that what happened in that period is we had a slow rally from 8,000 to 12,000. But from 2018 itself, closer to 11,000, the small cap and the mid cap index were only falling. This was an odd time because the Nifty went on making new highs. The small cap, the mid cap, everything apart from the top 10, 15 names actually were in the downtrend. Cut to it, we come to 2020. There is a nice recovery in 2019. Corporate tax rates are cut. Various things are looking fine, and you get COVID. And we have a fall of 40% on the index in quick time. Look at the small cap index. This is what I'm talking about. 20,183 was the BSE small cap. Then you got the long-term capital gains. Followed by that, over the last 5 years, we've not made, the government has not made any money from the long-term capital gains, but all the investors lost money in that. Now, what do we have? There was a nice recovery going on between 2019 to 2020. We are going back to the same highs, and bang out of nowhere comes COVID. Now, we have a 42% fall on the small cap index, but from the top, we've got a 57% fall on the BSE small cap. So again, a 50-55% on the BSE small cap. So what happens is, how do you get to this bear market and how do you try to bottom it out? Or how do you find that the things are getting extremely oversold? So we actually wrote an article on 24th March 2020, a long article comparing bear markets of 2008 and 2020. Now, that is one of the articles which me and Harsh are very proud of, because on that day, to be actually writing when you've lost a significant amount of your net worth, the markets are terrible, and instead of losing hope, you are creating a proper analysis which tells you to be more optimistic. So this is a very simple comparison. This we do it very often, which is where we take the whole list of stocks which are there on NSE. What has been the return across the whole spectrum, the breadth? Same way we did it for 2018 to 2020, and 2008, January 2008 to October 2008. Now, if you look at it, this is very similar, right? At that point of time, 79% of the stocks are down more than 50%. 87% of the stocks are down more than 50% in 2008. Now look at the stocks more than down 60%. 70% in 2020, 79% in 2008. Same way, 56% of the stocks are down more than 70%, 60% of the stocks are down more than 70%. So you see a lot of similarity. The big difference was 2008 was preceded by a bull market. 2018 was not preceded by a crazy bull market. So you could not have been this was never as bad as ever because there was no craziness before this move. So this is what we wrote. Shorts need to be extremely careful. It will take a lot of guts to buy equities today, but this is the time when multiple returns happen over the next few years, right? And this is what happened. So this is a good article. You can look at it, go back. So brutal bear markets will see generally you losing hope, but the recovery is extremely fast. So there are both the sides of it. The only thing you have to remember is do not average on the way down. The next one is the time correction bear markets. We'll try to take Q&A post the session because then it would be interesting. Otherwise, if I take the questions now, we'll keep getting longer on the webinar. All right. So the next topic is time correction bear markets. Now, these are bear markets which are tough because this may happen after a brutal bear market or happen after a recovery after a good bull market. So if you look at it, some of the toughest corrections from the 1990s, 1992 fall, we go back to 1994. 1994 to 1997, 98 was terrible, right? 2000, we go into a Y2K boom. 2000 to 2003 was a 3-year period of consolidation, time-wise bear market. The markets were in a bad situation and it remained there. Same way, 2008 to 2010 saw a recovery. 2010, 11 to 2013 was almost 2-3 years of a time-wise correction bear market. Same 2018 to 2019 was similar. The worst part is we got COVID at the end of it. Now, what happens in this time-wise correction bear markets is benchmarks take a knock and they start consolidating, right? So after taking the first knock, they start consolidating. But the small caps continue to drift lower. And the indices, the small cap indices fall 50% from the peak. So let me take this example between 2011 to 13, 2000 to 2003, 2018 to 2019. Now, this is the period of time. It was 2 to 3 years. In 2013, say the Nifty had made a low of 4,500 in 2011. It was at 1,500 in 2013. But the small cap indices broke the lows equivalent to 2011. So that is what I'm talking about. So that is how bad it is. So what do you do in this time-wise correction on the bear markets? Now, in this bear markets, because they're gradual and over a period of time, there is a different leadership change. So what happens is there are few sectors to hide. So when I say sectors to hide, they actually give a lot of positive returns. So the relative return is superb. So you can have a relatively higher allocation to them, which can help you reduce your drawdowns. And if you have a very high allocation, you actually come out making returns in that period, which is difficult, but at least if you can save yourself from a major part of the drawdown, the next cycle will be superb for you. Now, take an example. We'll see the charts also. In 2000 to 2003, it was PSUs, metals, and a lot of value old economy stocks, which started doing well from 2000 to 2003 start itself. Then in 2013, it was all about FMCG, pharma, home building materials, and a lot of quality names. So the whole quality cycle started in 2013. Now, the best opportunities get created here for the next few years because the valuations are extremely low, expectations are low. And this is the period of time where you actually, over the next few years, multi-baggers are made via two things. One, earnings also grow and PE also grows. So that is the best way you get a bull market. So this is what happened in 2003 to 2007, 2014 to 17, and 2020 to 23. Now, the general mistake is you lose patience because it's a period of time. It's not just the price fall, but the period of time. And what happens in this period, the alternative choices are also interesting. Say in 2011 to 13, there were tax-free bonds, which were at almost double digits. Today also, what do we see? You have a nice fixed income return, which is possible to be made. So all the people in 2007 were putting money into ULIPs. Finally, after the 5-year period, pulled out money and put it into fixed income. So you lose patience, you be lack of belief, and the whole confidence is gone. And that is the time where the next set of returns are made. Now, this is 2000 bear market. So you've fallen from 1800 to 800. Then there is this consolidation, which continues from 2001 to 2003. The breakout happens here in August, but a lot of stocks start doing well from this period of time itself. So look at this example. The BSE PSU index, it started breaking out in May 2003, Feb 2002, right? So if you are into PSUs, you have a bull market from Feb 2002 itself. And that was the leading sector of the next bull market also. So one thing which we need to learn in the sideways correction, the time-wise correction bear market is the stocks and sectors which starts taking leadership in that period of time could actually also do really well in the next bull market. Then you have Bharat Electronics. The stock, say, was 50 paise on an adjusted basis. Today, the stock is 100 rupees. So it started breaking out from 2002, did really well up till 2003 as well. This is where the Nifty breaks out, but this has already done well. So in that period of time, it's gone from 50 paise on the bottom to 1 rupees to already 3.5 by the time the index breaks out. Then BHEL, one more stock, Jan 3, 2003 breaks out. GAIL. So a lot of PSU stocks started breaking out. ONGC. Now, interestingly, ONGC by 2007 was the 4th largest company on the Nifty. Tata Steel started breaking out, started doing well from 2001, 2002 itself. So it was at 4-5 rupees in 2001. By the time we were in 2003, it was at 10-12 rupees. Hindalco. So a lot of metal stocks started making their move from 2002. Then a fresh breakout in 2003. Indices broke out in August. A very similar bear market happened in 2011 to 2013. So look at it. The first chart above you is the Nifty. So the Nifty has been between 6,300 to 4,500. 6,300 being a major resistance. There is a nice strong recovery in 2011 to 12. A lot of global markets also recovered really well. But we did not see a huge recovery in the small cap index. It had fallen 52% in 2011 to 10 to 12 itself. Then in 2013, it made a fresh low. The Nifty has not made a fresh low. So this is what we call as the opposite of the crazy divergence in 2007 to the crazy divergence on the other side, where there is too much pessimism, although the index has not fallen. So this was the best possible time to increase small cap exposure, similar to increasing cash in 2007. The exactly opposite. What happens? We start seeing a rally. The breakout starts happening here. And this was a period of, say, November 2010 to August 2013. Now look at it. Look at the hiding spots. Even in this period of time, there are hiding spots. When I say hiding spots, they give you solid returns. And they do not fall as much in the correction. So they'll start breaking out in 2012, but they'll not fall a lot in the next correction. So this is Nifty FMCG index. By the time between 2012 to June 2013, and by August 2013, where the index has fallen by 50%, the BSE small cap, the Nifty has also fallen 20-25% from the top. This index has gone up 50 to 70%. Hindustan Unilever starts breaking out in 2011, makes a high after almost 10-12 years, does really well. Dabur, similar, 2012 breakout. Colgate, ITC. Now, this is very interesting. It broke out in April 2011, broke out in March 2012. And by August 13, it was the largest weight in the index at 10%. It was, say, one of the best performing stocks. So it did well and it was the largest weight in the Nifty, right? Add to it dividends, it did really well. Now, from 2013, at that point of time, FIs used to own 20-21% of equity. By 2022, FIs own only less than 10% of equity. So it went from being the largest in the Nifty to becoming a meme stock. And that is how market cycles are. Now, the other big performer was the Nifty Pharma Index. You could look at it. It's a classical bull market out here. Newer highs, newer breakouts, newer highs, newer breakouts. And all through this period, you have the small cap index down, the Nifty down. So this was the next performer. Now look at Sun Pharma. The stock went from 200 to 1200 in that cycle till 2015. But it was 200 to 600 by 2013 itself. Now there was Cipla, there was Dr. Reddy. You could pick a lot of stocks in the pharma names. Then there was this period of time where home building materials did well. A lot of other stocks also. So you had Sera. So a lot of quality stocks where learnings were there did really well. So this is where the whole divergence happens in terms of if you are invested in the previous cycle leaders, you'll keep getting hit. Because say if you bought the infra names of 2008, they'll be falling down in 2011 to 13. Somebody will be folding up. So every cycle leads to new winners. So now if you look at it in that period, there was IT and ITC, basically FMCG and pharma. So if you have a good allocation there, that would take care of your return. Say the drawdown to be lower, and you could actually end up with a return also if you have a very large allocation to that. Now we go to 2018 to 2019. Now look at this divergence. Out here, up till this point of time, the Nifty was struggling, but the small cap just continued. So I have an article in December 2017, how long can this continue? And that is the time we initiated a increased cash call. I should have increased a lot more cash, but that is how markets are. And then you get LTCG coming in, which actually hit the small caps a lot more. Now, so in this period of time, there are two things you can do when you get a divergence. The first thing, which is easy to be done, stop putting new money to work. So stop putting new money into the markets. Second is to increase cash. So initially, you will start learning in your first cycle how to stop putting new money into the markets. And then over the next cycle, you'll start learning how to increase cash. Now look at this. Now this was a very tough market because this is the first time we actually saw Nifty making new highs. So in the previous cycles, we saw Nifty also going sideways and the small caps falling down. This was an odd one. Nifty went on making smaller highs, but the small cap index kept on making lower highs and by a big margin. So it was already around 40% by the time we were in 2019. It was a classical divergence where it all indicated to positive things to happen and trends to change. And it started trending higher. From 12,000, we are already closer to 15,000. There was a good 20% move on the small cap index. And then came COVID, which just killed the index. So this was a tough one. Now, in 2018 to 2020, there were hiding spots. Now, the hiding spots were tough because it was only large caps which did well. So there were very few stocks in the mid caps and small caps which did really well. Now, the problem here was between 2014 to 17, the best performing stocks were mid caps and small caps. And then you ended up believing the fact that the only way you can make large money is via small caps. And what happened in 2018 to 2020? 2017, Jio plans get announced. The stock is at 550 rupees. And by 2019, it is at 1600 rupees. So we end up getting into wrong beliefs in every cycle. So by 2017, the only way to make big money was in small caps. And the best performing stocks in 2017 to 2020 was the largest company in India. So that is how markets are. So the hiding spot was a Reliance Industries. There was a HDFC Bank, which actually went on making new highs between 2018 to 2020. But these were tough hiding spots because HDFC went up by 30%. So that's not a huge return over a 2-year time frame. There was ICICI Bank, which did well. Now, ICICI Bank was in its own cycle. Then in 2018, it actually bottomed out with a lot of some changes. So it went from 270 to 550. So this stock actually doubled between 2018 to 20. Then you had Infosys, which went up from 520 to 840. So this was a tough market, 2018 to 20. because 18 to 90 was tough, followed by 2020. So in this period of time, you will get hit because you saved yourself up till 2019 and then COVID came, which there was hardly any hiding space. So then we go to the next market. So what do you do in a time-wise correction bear market? Sit on your cash, try to focus on the hiding places and wait for the right time, the new leadership to develop. So the whole process is that if you survive the bear markets, you'll make a huge return in a bull market. And if you can actually make money out of at least the next market, which I'm talking about, the sideways market. So brutal bear markets, you can't make money. Time correction bear markets, you can make a little money or save yourself from a big drawdown. The sideways market is interesting because this is where the Nifty is sideways. The stock, the small cap index is down, but you could still have a positive return. So let's look at this market. And also the reason why we look at this market is we'll tell you next when we talk about the current market view, because that is where it gets very interesting. Now this is the sideways bear market, which could be part of a bull market correction or a consolidation after a good market rally. So this is what we call as on a longer term, it could still be your part of a bull market, but the correction is pretty large. So the benchmarks fall by 5 to 25%, which is Nifty and Sensex. But the small caps are relatively not as bad. So generally what we've seen is, say if there is a 10% correction on the Nifty, you can assume a 15-20% correction on the small cap index. It's generally more than 1.5 times to 2 times the normal market correction. But this is a period of time where actually small cap indices at times fall lesser than the Nifty. But there will be a lot of stocks which are down. Now, in this period of time, you have a lot of stocks which can give you outperformance. So when I say a lot of stocks compared to the brutal bear market or the time correction bear market. So in 2015 to 2016, there was textiles, there was chemicals, and luckily we were invested in this segment. So it was one of the best outperforming periods for us. Then in 2021 to 2023, there will be multiple themes. So you got capital goods, which is a theme which continued. You got banking in 2022. Then there was PSUs, there was manufacturing. There were a lot of value stocks and there were short-term themes like opening up. There was a fertilizer theme in between as well during Russia-Ukraine. Now, this is again the time where you can actually say in 2008, there is no way to save money. In 2011 to 13, there are only 2 sectors, but out here there will be multiple sectors, multiple stocks. So for example, 2015 to 16, we had our best outperformance. In 2021 to 23, for example, the small cap index has hardly given any return. From 2022 to 23, it is negative. 21 to 23, it is not great. But we had a solid return in all our services. So we were up 50% in 2021-22. In 2022-23, we are up 20% in most of our services, whether it is Traders Club or small case. So, but that is huge against a negative return on small cap. So the alpha which you make in this sideways year is huge, even which you can't do in a bull market as well. So that gives you a huge heads up in going into the next bull market. Now, this trends start post this. The thing is, after the sideways consolidation, a new trend starts out of nowhere. So after 2006 correction, 2007 madness started out of nowhere. 2013 correction, 2014 elections, and the markets rallied. 2017 post demonetization. So the best part is, if you outperform in this sideways period, you actually have a larger amount of portfolio. So you make a killing because you've already made money in a sideways bull market. So you make a huge killing in the next euphoria. Now, the general mistake in this sideways bear market is people keep on sitting on cash. So 2021, there was madness in digital companies. There was madness in all of NASDAQ, a lot of these companies which were not making profits. So it is logical to stay on cash. And people keep sitting on cash for this 1.5 years. But that is 1.5 years where you could actually make really good returns, right? So even though the Nifty did not go anywhere, you had a lot of opportunities to make return and you missed out on it. And you stop focusing on the good side of it. So today also, we are in a very similar bear market, sideways bear market, which is where we are in right now. We are not able to see the good part of things. We are only able to focus on the wrong side of the market. So this is 2006. You got a good 30% correction on the Nifty in quick time. You had a 40% drop in the small cap index in 45 days. Nifty makes a new high. The small cap recovers back, but you've not had a good period of time between 2006 to 2007 mid. But then out of nowhere, 2007, you get the best bull market. Then 2015 to 16, interesting. What do we notice? Nifty fall from 9100 down to 6800. That's a fall of 25%, right? In the same period of time, if you look at it, all through that year, you have the small cap index coming back to 52-week highs again. So Nifty has struggled. The small cap index has held on. But in the last fall, even the small cap index breaks down, breaks this support, and it is also down 22%. But look at it, from the peak, it is down 22%, but the Nifty is down 25%. Ideally, what should happen? A 25% fall in the Nifty should lead to a 30, 35, 40% correction on the small cap. So this is a period of time where the small cap index has relatively outperformed. Now, what happens from that period of time in 2016? You go from 9,400 to 13,600. Now, this is a time, actually, I remember around 15 February of 2016, exactly at this point of time. I have a YouTube video also on the YouTube channel, which is where I did a presentation in one of the seminars. The video is there. The title was Beg, Borrow, Steal and Invest. Right? So nobody's going to beg or borrow. Nobody's going to beg to invest, but yes, borrowing people can do, but definitely nobody is going to steal to invest. But the reason I had to actually make that tagline is because the belief is gone. There is a lot of pessimism, even though the markets have not corrected a lot, right? A 20% correction is not a lot, but because it has spent 12 to 18 months in that fall, there is a total lack of belief in the markets. Even though you've not got as badly hit like you got hit in the previous bear cycles, but the belief is gone. So to actually create that impact, this is the tagline which I gave in 2016. And I've explained it very similarly, looking at the Nifty, PE, etc. I'll try to compare the current markets also very similarly, because this is where we are right now, according to me. So what happens between 2016? You go from 9,400 in February to 13,600 on the small cap index, a good 30-40% bump up. Now, when the small cap index goes up 30-40%, you can expect a lot of stocks to do really well. So this was the period of time. Now, there were a lot of hiding places. Now, how do we find hiding places? So what is the simple rule to find hiding places in this sideways bear market? So basically, what do you notice? Nifty starts drifting lower. So ideally, stocks also should start drifting lower. Now, stocks and sectors which do not fall a lot is your first indication. So in this fall to 2016, or this bottom, stocks which do not fall a lot is your first indication there is possibly going to be outperformance here. The second is the Nifty has not made a new high. The small cap index has not made a new high. Which are the stocks which are making new highs? Now, that is the stock and sectors where you want to participate. So you'll get your hints early in a lot of them. So look at this example. So this is 2015. This is the first time Welspun Vardhaman Textiles makes a new high. Does not fall a lot in 2016. Does not break the previous lows. Starts making new highs before the index. Does really well. You have a KPR Mills, which does really well from March 2015. So this is where the Nifty has stopped. The stock goes up another 30-40%. Does not break the new low in 2016. Nifty has broken the low. The small cap index has broken the low. So stocks which do not break the low. And then it is the first one to make a new 52-week high. So this was one of the largest holdings which I had personally, as well as in our recommendation list. So the stock did really well. And even today, it is the best performing textile stock. there were many such names. So there was a lot of smaller textiles as well. We actually came out with a note in 2016, textiles and chemicals as a sector, but nobody was interested. Very similar to the note in 2022, we came out in banks, that banks are the next place to be, right? So there is so much of lack of belief that there will be low. So one of the indications which we get is when there is low participation also. Now, so there was Deepak Nitride, Naveen Fluorine, which kept on doing well. And what happens after that is, so we started focusing on chemicals in 2015. By 2018 to 2022, what happened? All these chemicals were now named as specialty chemicals. And this is where the cycle created its peak, just the way pharma did in 2015. So this is classical. What happens is there is low valuation, good earnings, good prospects, and the market keeps rewarding it. So pharma was supposed to be a pessimistic, it was supposed to be a defensive sector, a sector which does not do well. 2012 to 2015, the sector goes up 3x, 4x. And then we suddenly talk about how pharma, India is the pharma factory of the world, etc., etc., etc. And since then, what happens? Sun Pharma is still not back to the same highs. Lupin is down 50% even after 8 years. A lot of pharma companies are struggling, right? So what happens is the sector starts outperforming, nobody looks at it. Keeps on outperforming, then everybody starts looking at it. So for example, a lot of these textile companies and chemical companies hardly had any allocations from the FIIs and the mutual funds. To give you a classic example, when we got into KPR Mills in 2013 to 14 and 15, there were only 2 mutual funds invested. And I think today there is more than 10, 15, 20% of equity, which is owned by mutual funds. Same is the case in Atul, which we looked at in those cycles. So today, a lot of these specialty chemicals have 20% allocations by mutual funds, 10% by FIIs. There were hardly any of them in the previous cycle. So by end of it, this is what happens. Same thing will happen in every cycle. So in 2020-21, we started talking about API companies, CDMO, then how digitization would change everything in the world, cloud, etc. And a lot of these companies have now faltered. So this is how the market cycles are, and this is how it will always play out. So now look at the structure in 2021 to 23. It is very interesting. The reason when I say interesting is, this is, now you look at this slide, you have 18,600 on the Nifty, 18,350, 18,100, and we were 15,200 as well, 16,800. But look at the small cap index, 30,000, 31,000, 30,000, 30,000, 30,000. Now go back to looking at it in 2015-16. Can you see the similarity? The Nifty is struggling, makes a recovery also, but this is 12,000, 12,000, 12,000, out to 11,500. So this whole period of time, you have a similarity, very similar, wherein the small cap has not done bad. There's an actual article which I wrote in November 2021, titled Back to 2015. So, and it has played out exactly. So this is where we wrote the article saying the first drop has happened. The swing lows have broken. It looks very similar to the 2015-16 cycle, where we will get into a period of time where a lot of changes would happen. A lot of stocks which were sectors which were doing well would, let me try if I can. Take that article. So this is Nifty 50 breaks new swing lows. So this was the first time we started seeing swing lows being broken. So this is what we said. It looks very similar to this cycle. And we see this this is exactly what has happened. We've seen a sideways to a downward drift in the Nifty as well as the small cap index, but still there was a lot of return to be made. Now, so this is what we said. Everything going up is over. It will be very selective, new sectors. One has to be extremely careful on the COVID beneficiaries. Now look at this timing and go back and look at the stock prices of pharma, mid-cap and small cap IT in November 2021 and where they are today, right? Then I spoke about how specialty chemicals, the cycle is over, very similar to 2015, where people did not know about FDA. How does FDA work? And then there was a lot of problems. Today in specialty chemicals, people do not know how long it takes for a chemical plant to come into place. There could be delays as well as the margins could be terrible with new expansions, etc. We could well top out or underperform for the next few years. Simply put, time to exit specialty chemicals. Now we kept on hunting for various stocks. We got power right in between and real estate did well. Then we got Russia, Ukraine. So this was the classical cycle catching also we did. Now, the reason I'm talking about this is because this is builds up to what happens next from here on. Now, look at this. What happens in this case? Out here, we did a 26% correction, very similar to 2016. It happened faster. Now, in this correction, if you notice, the small cap index broke this bottoms, very similar to what happened here. So this looks like a breakdown, everything going down, and then a rally comes out of nowhere, right? Could this also be a start of a similar rally? We don't know. But the fact is, your risk reward is superb here. So we just initiated a recommendation saying fresh cash to be deployed in markets on 29 March to our clients. We said you can deploy into the recommended stocks plus 3-4 top stock picks we still like, where you can have a higher allocation. Now, since then, the index has gone up from, this is 29th March, the next day it made a bottom. It's gone up a good 5 to 10% in that period of time. So most of the stocks are up 8 to 10% in that period of time, say till today. Now, let us look at this time-wise correction market. What happened in 2021-23? How there are multiple opportunities. So we came out with this note in June 2022. It was a free report, which was there on the website. So it is not something which I'm talking about trying to curve fit something, which is where we put our neck on the line and say, this is what we think like. Now, Bank Nifty, a very simple reason to actually go Bank Nifty, apart from various other reasons you could point out, I've given a lot of fundamental reasons as well, was the fact that pre-COVID, the index was at roughly around 31, 32,000. And in 2022, June, it was at 32,000 roughly. So the biggest hit for banks was the COVID and the related economic slowdown, plus the risk of NPAs, etc., credit growth, various reasons. But now cut to 2022, what has happened? If COVID is gone, what should do well? Stocks and sectors which got hit via COVID. Because by this time, markets have clearly called out COVID. So you can go back to the history, January 2021, COVID cases top out in Mumbai, all diagnostic labs topped out, and they're down 50, 60, 70%. So by June 2022, what was very clear is all COVID hit companies, sectors should actually do well. So banks, you had a classical condition of risk reward being superb because 3 years of zero return. A lot of stocks actually had negative return, large banking companies, and COVID is over. So you had a strong base, and this is what happened next. So when we came out with the note, I think it was around 24th June 2022, we were at 33,000 roughly, or 32,500 to 33,500. We got a 10,000 points move in Bank Nifty. This is much before the breakout, exactly at the bottom. So this is where the report came out, right? So this was a huge opportunity. You could have bought any of the banks and made money. Then the other hiding spot was capital good companies. Now see, like I said, what happens in a sideways bear market is the sectors which start breaking out, when the markets are struggling are the ones which actually do well. Now, this is where it started breaking out. Capital goods did really well. And the whole sector was the best performing in 2022 to 2023. ABB, Siemens, CG Power, Bharat Bijli. So this is one of our holdings, which has been a core holding for the last 1.5 years. This actually broke out in 2021, which is where the market stopped out. Did not break a new low in the next correction of Russia-Ukraine. And then you see the leadership. So the stock went up from this 1400 bottom to 2800. Just like I was explaining about 2015 to 16, ones which break out in 2015, do not break the lows in 2016, actually do well. Same thing happened, classical similar example, 2021 December, Nifty has topped, the stock gives a breakout, does not break the lows, and then again rallies. So this is how we use Techno Funda, wherein our focus was capital goods, fundamentally was also looking interesting, technically also. Same was the case in 2015-16 for textiles. Then a lot of defense companies started breaking out in 2022, did really well. So you had HAL, Bharat Dynamics. Then this is another related to capital goods company, Sangvi Movers, which did really well. For us, we sold out of it. Then opening up theme. So this was one more interesting theme which we caught and still looks very, very interesting. So that is Wonderla. The stock, even today, after the IPO, which was very well sort of 8 years back, the return is 0. So to make a conclusion out of this whole exercise, so what is our strategy in this bear markets? So the first strategy is to survive in a brutal bear market, wherein you don't lose out your whole capital. Because something like 2008 happens, a lot of people, so there is a saying, a set of investors who came in 1992 did not come back for the next couple of decades or till the next cycle. People who lost out in 2008 actually did not see equity markets up till 2020. Very similar to 1992, Harshad Mehta guys came back only in 2003. It takes almost a decade for a lot of people to actually heal out of that bear market, right? So all you need to do is survive. Do not make crazy mistakes. So there's a saying which my mama, my mentor says, Mr. N.S. Fidai, no capital markets. So in a brutal bear market, by leveraging, you can lose your entire capital, or you can lose out 80% of your capital by averaging. And you just stay there. As much as you average Yes Bank, it is not going back to 350 rupees. Because if it goes back to 350 rupees, it will be the largest company or maybe the second largest company in India. All right. I'm not even talking about the bank. It would be the second largest company. So as of today, even this price is, I think it is at on a diluted basis, 60-70,000 crores market cap. The peak market cap of Yes Bank was 90,000 crores. So if you say it's going to go up to what? From 70,000 crores to 20 times, will it be 14, 15, 20 lakh crore market cap? No, it will not be, right? So averaging will not help you. It will only kill you. The second one is, what do you do in a time-wise bear market correction? Try allocating more to hiding places. Do your research well, because this is the period of time huge multi-baggers will be created. When I say huge, there will be stocks which go up 5x, 10x, 20x also. So in this period of time, if you have hidden well, you've actually come out with a unhurt, your portfolio will still be there. You would be adding new money to the markets. You will make a huge return over the next cycle. The next one is what we call as the sideways bear market. You got it in 2006, 2015, 16, 2021, 23. If you outperform in this, see, the simple point is, if 2021 to 2023, your say index return is 100 to 120 and you are at 100 to 180, imagine what sort of advantage you have in the bull market, because you are already higher. And then even if you don't outperform the bull markets, you have a significant outperformance. So you will outperform meaningfully. And this is where we are. So according to us, we are in this sideways bear market. And out of this markets, what happens next? So that is where we go to the current market view. Okay, what happens after this? So this is where I finish what is the history, where we complete 1, 2, 3. And the best part about India is, because India is a growing country, right? You have bull markets which are very, very kind. So you could buy anything in a bull market and you do well. So we've done a lot of random portfolio exercises. Random portfolio beats the index by a huge margin in various cycles. So luckily, our bull markets are very kind. So for example, if you were to look at the Nikkei from 1990s or the UK markets, they've not, or German markets, they've not given returns over the last 15, 20 years. So luckily, we are in a good growing market. So every bull market, you make a, say, a huge impact. Now, the current market view. So if we were to compare that, what happens after this sideways market? What happened after 2006? We got a killer market in 2007. We went up crazily between 2007 start to 2008. 2016, we bottomed out in February. We saw demonetization in November. We saw a new, say, a new leadership in the US. And 2017, it was a bull market, which was clean. 2007 was clean, right? So what we've noticed is after this sideways market, which could last, say, maybe 2-3 years, at least 18 months and on minimum scale, we've already 15-18 months in this market, say from October 21 to March, April, we are already there 15-18 months. A bull market comes out of nowhere. And a bull market in this, after the sideways period, is very clean with very low drawdowns. That is the most interesting part, right? So look at this example. So I've taken the chart of Nifty from 2008. So this is 2010 to 2013, a tough market. Now what happens by 2013, August? Now let us look at the negatives, which are always there, right? And today the problem is over-information or overexposure to information. Because what really hits your Twitter timeline, your YouTube timeline, your Google alerts is the negatives, right? And today we are overexposed to all the things which you read. So there is over-information, and there is nobody is going to talk about the good side of it because nobody is interested. It does not hit you. It does not get you the hits and clicks, right? 2013, USD INR hit 68. Mind you, in 2008, it was 39. So that's huge. There was taper tantrum. There was bad loans, which were struggling from 2007-8. Global conditions were bad. 2011, you had a classical cycle of a lot of pain across the world. If you remember 2007-8, it was about BRICS. Then in 2013, it was about pigs, which is where you spoke about Portugal, Ireland, Italy, Greece, Spain. And there was supposedly bankruptcy in countries, right? This is where the bottom is made in 2011 to 13. And from that point of time, the returns are crazy. Then 2014 elections. Before 2014 elections itself, the global markets are already broken out. So you have a rally from 2014 to 15. You go from 6,000 Nifty to 9,000 Nifty in a year's time or less than that. Then you get a correction in 2015-16, overvaluations. Earnings did not catch up. There was a lot of election-related buzz, but earnings did not catch up. Global concerns were there. 2016 February was the time where the long-term capital gains rumor came in. Did not happen at that time. And the bottom happened out of nowhere. Good recovery in 2016. Then what happens is you get a drift in 2017. After that recovery from 6,800 to 8,900, you get a drift towards 8,000, a 10-15% drop on the index. Now, in this period of time, what happens is demonetization happened later, but Donald Trump coming in happened, which was not expected. So demonetization and the US election event happened on the same day. But it was the US event which was known, demonetization was not known. Now, what happened post demonetization? We read all about demonetization. The first thing which comes up on our mind, demonetization hoga to real estate will be killed, right? A lot of business will get hit. There will be NPAs in the financial domain. NBFCs are going to go off. What happens by 2017 end? The best performing sector of 2017 was real estate, right? So the markets are a very different animal. So the best performing stock was real estate, which is unusual, right? Because your first thought was that. Then Bajaj Finance was a good performer, although it took the largest hit. So a lot of stocks which took a largest hit did well. And by end of 2017, what did we start talking? Financialization happened because of demonetization. And that led to the bull market. That is how SIP money came into picture, etc. So I've been talking about the SIP inflows from 2016, 2015. We came out with a note saying flows to float and how the Indian domestic money is going to be very important. You can search for flows to float on the website. You'll get a nice report. It's a very long report. I don't want to discuss it right now. But demonetization happened in India, not in the whole world. But January 2017 to December 2017, 90% of the global markets, 9 out of 10 global markets did not have more than an 8 to 10% correction from the top to the bottom. Do you think it happened because of demonetization in India? Definitely not, right? So this was a clean bull market. When I say clean bull market, no corrections, slow and steady, nice move up. So we went from 8,000 to 11,000 between 2016 December to say 2018 start. So 1 year, solid return without any corrections. So bull market starts out of nowhere. 2020, you get a correction. You have COVID, a lot of uncertainty. Now we see a recovery back to 12,000. But 12,000 to 18,000 was also a clean rally. But in that clean rally, the small cap index, so Nifty is back to 12,000. The small cap index was still down 30%. So you had the best rally in small cap between November 2020 to October 2021, right? So the market tends to surprise you. Now, if you look at it, 2023, things come out of nowhere. Like 2016, you saw a fall out of nowhere. 2022, we saw Russia-Ukraine war out of nowhere. Who would have thought that this would, an invasion would take place, a war would take place? And even when it took place, was it going to last more than a year? It was talked about to be 48 hours to 2 weeks to 2 months. It just continued. So that's the reason understanding macroeconomics is a lot more difficult and we tend to avoid. We will look at technicals. Because if I were to give you a prediction saying crude will be $140, $130, inflation would be this, Fed would be doing this, interest rates would be this, there would be a risk of recession, there would be a risk of war. What would you have expected Nifty to be from February 2022 to March, April 2023? You would not have expected a positive return or a zero return, right? So this is how markets are. So that is where technicals helps you remove out all the information, focus on the price action. So that's how in June 2022, you could take a call on banks. Okay, the risk reward is great. Price action is not that bad and it could start a rally. So that is how we try to mix all you understand or all you read with price action. So today, if you look at it, this chart looks this cycle looks very similar to this. Now, I don't know whether we are at this point of time or somewhere here, right? Because this happened a little fast. This took a lot of time here. And this recovery, we went on to make new highs. But if you were to take an exact time cycle, sometime over the next, say 6, 12, 18 months, 3 months, we could actually get into a bull market out of nowhere, right? And the opportunity is very, very interesting. So a lot of things are very similar, things which came out of nowhere in 2022, and the markets have seen the worst. So the view is structurally very, very positive. Now look at the current market view in small caps. Now, this is how the functioning of the brain is, right? You can look at the small caps index, and this is two ways your brains will think, right? A lot of people are looking at the markets from the spectrum of the 2020 lows, right? Or from pre-COVID levels. Now, remember, pre-COVID, the index had already fallen 40%, the small cap index, right? And in COVID, we had fallen 40% from the start of COVID, right? So if you compare today's market with that period of time, what happens? From the bottom of 2020, the small cap indices are up 3x. From pre-COVID, they're up 2x, 1.5 to 2x, most of the small cap and mid cap indices. So this tells you, oh, the markets have done really, really well over the last 3 years. right? One has to be cautious. Then you look at the same data from 2018, the BSE small cap cumulative was up 40%, which is almost lesser than the fixed income return. And over a 5-year period of time, BSE small cap, the worst possible index, you are making less than single digit returns. CAGR basis, you are at 6 to 8% CAGR. It's terrible, right? Then you look at the Nifty small 100, the returns are zero. So you can look at the same data and you can have two viewpoints. My view is one has to be cognizant of the fact that the 5-year return is not that great. The 3-year return has been great because of a fall for COVID, right? So what we've noticed is we tend to look at various data points from the way we have a bias, right? So these are the two data points. I believe one has to take the middle road and see there are a lot of opportunities. Now, what do we generally see? We'll see the chart next is a good time to build small cap portfolios when last 5 to 7 year return is low, right? Most of the people want to come into small caps when it has done well. I actually remember in 2015, right? Right. So this is what happens. So this is an old exercise we did. So you can actually go and search on Google Trends. So in 2015, 16, 2013, the markets were terribly oversold. Valuations were crazy. You could buy stocks at 1, 2, 3 PE, 50, 70% discount to their replacement value, cash bargains, etc. So by 2015, what had happened? A lot of stocks had become multi-baggers, similar to what happened in 2020 to 2021, 22, right? So multi-baggers as a keyword search in this is when January 2016 had touched a new all-time high on a relative basis. And we saw 20-25% fall in 2016 itself. Same thing happened in 2000 post-COVID. Now, this was a beautiful period for investors because generally what happens is a lot of participation from the retail comes after a bull market in a big way. When you see your neighbors making money, your colleagues making money, your distributors making money, everyone you know, vendors, etc. is making money and you've not participated. So you want to get in. So 2007 is the time where there was a lot of retail participation. 2015, 16, 2017, people started coming into small caps. Everyone wanted to find multi-baggers. But 2020 was interesting. Now, you could not have got such a beautiful period. Why? Markets fell 40% out of nowhere. The majority of the world is sitting at home. And now, valuations are low, the markets have fallen. You have a lot of time. So a normal individual does not have a lot of time because you have your job, you have your business, which takes away a lot of time, you have family. So the time is very low. You have say a lot of money still left in your accounts. And more importantly, there was some bit of equity culture. A lot of people had started doing SIPs. And the last and the most important point, which actually has led to this equity revolution, is the ease of investing, right? I remember in 2006-7, I actually had a SIP. I had to give 6 post-dated checks to start a SIP, right? So it was financially not viable for a distributor to send someone to collect a check, deposit a check, right? And the SIP amount is 500,000, 2,000, 5,000 rupees. So if somebody is paying 60,000 a year and you're making say 2% also out of it, you're making 1,200. Your cost of running this exercise is 600 to 1,200 rupees. So you make nothing. So SIP as a product was not sold in 2007. And the best part is what was sold? NFOs, right? So because the product was not viable, ULIPs were sold because there was 25-35% commission. But something happened a few years later. There was electronic clearing system, which implied you did not give post-dated checks. So you could just give an instruction and the account would be debited with the SIP instruction. We could actually make bill payments which were automated. So ECS was the first trigger for mutual fund SIPs. Suddenly SIP became viable. And that is how SIP started being sold. It is not suddenly a change of heart, because the finance industry is very simple. It sells you what can make money for them, not for you. That's the fact, right? Because that is how the industries work. So SIP became a super product. Then cut to 2020, we had come down from a point wherein back in the day, when you opened your first Demat account, you needed 40 signatures. And now what could you do? You could do a video verification and open an account. So there was a time where it would take at least 2 to 7 days to open an account. And that too online, without you going to the broker and sending physical, right? So that was the big change which happened in 2020. So it was ease. The next part, you could trade via your mobile phone, right? See, e-commerce also saw a shift when you could do it via the mobile phone. I remember at some point of 2021, as per the NSE mode of trade data, 25% of all orders were being sent via mobile phones, right? So that was the shift. So suddenly you get a period of time in 2020 where what has happened is ease of business to open an account, ease of, say, earlier you had to send a check to your broker. Now you could just transfer it online, right? So it would just take you seconds to take that investment decision, which was not the case a few years back. So, and also the fact, by the point of 2020, a lot of kachra was cleaned out. So a lot of companies which had to die, the Diwan Housings, the Kingfishers, the Jet Airways, a lot of infra companies. So there were majority of the 2007 and 10 excesses were delisted. So it didn't have many kachra. So the only kachra which was left, when I say kachra, is stocks which have fallen, was Yes Bank. And that you see is still has 50 lakh shareholders, right? So there were very few spots. So a lot of people are buying a Bajaj Finance and not buying some airways companies, right? So 2020 was a beautiful period where you saw large equity participation from retail at the lowest point of the market. Generally, before that, what would happen? The markets would rally and people started participating. So everyone made money. And by 2021, you have a lot of people making videos, various things on markets. You've seen comedians start trading courses. You've seen travel bloggers become option traders, etc. And today the whole world is all about option selling. And I think that is going to be the riskiest part. There could be some wild moves on certain days over the next 1 year because there is over participation in option selling. The markets are not easy. They try to make you look easy and suddenly take a big chunk of you. So like 2007, there were a lot of people doing futures and you got a sharp correction. There was a lower circuit in 2008. All right. So this is how the markets are. Beautiful period done. So now it's going to be a time where you have to start working hard. So this is where we are on the small caps. We've gone through this consolidation. Over the next 1 to 3 years, there could be a bull market which would start out of nowhere. It could already have been started. So view is extremely bullish. And now look at this. Best periods of time to make returns is when the last few returns are zero. 2016, 10 to 16 return, zero. 2020, 2016 to 20 return, zero. 2013, 2006 to 2011 to 13 return, zero. 2009 to 13 return, zero. So the best time to create a small cap folio is where the last 5-7 year return is closer to zero. 2020, because BSE small caps looks at the worst of the indices, that is where we saw a huge, this bump up is a lot more compared to the other small cap indices. So look at the Nifty Small 100, 2018 to 23 return, zero. 2020, what was the case? 16 to 20 return, zero. 2016, it came back to 2014 prices. 2023, it has come back to 2021 prices. So this is a good time to create a small cap portfolio. Now, quickly looking at some long-term charts. Do your own research. Please read the disclosure, which I said in the start. I would have positions. My teammates would have position. Family would have positions. So we are biased. So this is an index which I've been talking about, which is the BSE Nifty CPSE index. the Nifty PSE index. If you were to look at this, it's on a 52-week high, 52-week high, trying to do that a few times. Very surprising is when you look at the lot of PSE stocks, what happens is a lot of these stocks have dividends, which are very, very high. So if you were to look at a chart of, say, NTPC, today it is at 175 rupees. The 2008 highs are at say 220, 225. But if you adjust it for dividends, it has already made a new all-time high sometime back. If you look at a GAIL, the stock is 2% away from an all-time high. A company like PFC is at an all-time high on a dividend-adjusted basis. So a lot of these stocks have started showing fresh momentum. A Power Grid is very close to a new all-time high. It's 2% away. So there could be a momentum cycle which is possible in PSE. So one could, this is X of banks. Then Nifty Auto, this is where we looked at it in 2022. It has gone through multiple retest of the same bottoms, and the returns are terrible from 2018. So there could be selective auto stocks to do well, but I think auto ancillaries have much better charts. So auto ancillaries is a space which we are looking out for. A lot of stocks are making very nice breakouts, and that is a sector which could be interesting going forward. Then there is a company called Welspun Corp, which has gone through a 12-13 year period of zero return. The core business looks interesting. It's a saw pipe company, very closely related to oil and gas. Mr. Buffett is buying oil companies in the US. Aramco has hit the highest profit. So pipe as a core business looks very, very interesting. Then the next part is they've done buybacks, they've done dividends, etc. But now you have two option values in the business. So they've got two NCL under the fold. One is Syntex Plastics, which is the tank, the classical tank business, which was high margin. And there is ABG Shipyard, which they've bought both these companies for almost negative value if you were to look at it. ABG Shipyard. So this is an interesting company. The core business looks interesting. The stock is coming out of a period of 12-13 year return. So a long-term chart is what we generally find very interesting ideas. An example is Indian Hotels was 150 rupees in 2006-07, broke out in 2021, doubled up, a large cap company. So Welspun Corp. Then there is another company which is there in the defense space. After 2015 is trying to make a longer term trend change, Dynamatic Technologies, which looks very promising. Tata Motors just done nothing for the last 8 years, could be interesting. It's a long-term chart which we are tracking very closely. A short-term breakout is already done. On the index, one stock which could actually change a lot of stuff, because as a combined entity, HDFC and HDFC Bank would be 15 to 17% of the Nifty. And it has a 3-year resistance knocking at 1700, 1740. So that could be a stock which could decide the index going forward. Not a stock where I would participate, but would be interesting as a trade. There is a small cap company called Banswara Syntex. The stock should do 100 crores of PAT, available at 450 to 500 crores of market cap. Promising company, 5-year return is 0, is trying to break out. So these are just examples of the investments, the way we look at it, the same way we looked at a Bharat Bijli last year. Year, but if we are right in some cases, it would take care. So if you go wrong and lose 10-20%, and if you go right and make 50-100%, it takes care of everything. So that's the strategy we go with. So let me conclude this presentation, and then we'll take Q&A. So we are in a sideways correction, which generally lasts 2 to 3 years before it gets into momentum phase. See, 2015 to 17, like I said, 9,000, 6,800, 9,000, 8,000. Then we broke about 9,000. So the momentum phase could be at the end of the 3-year cycle. But by the time we are in 2016, like we were in 2022, the bottom could already be done. So the worst is we've already seen the worst possibly. And now we could take some time before we get into a momentum phase where we break about 18,500, 18,800. But the mid caps and small caps should already start doing well. Right. So we've already started seeing that. Same way 2011 to 2013. Momentum started in the end of 2013. But after August, after that bottom, there were stocks which started doing really well. So possibly we might have already seen the worst. The momentum phase starts once we start crossing the 2021-22 highs, like the 30,000 mark for the small cap index, the 18,500, 18,800 mark on the Nifty. And bull markets start out of no belief. And you cannot find reasons when this starts. So demonetization could not have been a reason for the bull market to start. 2006 was the first time subprime crisis being started spoken about. And 2007 saw madness out of nowhere when there was a lot of subprime reasons. Small cap returns of last 5 years is low. Good correction. We've seen a good correction from the peaks of 21-22. A lot of story stocks have corrected. So Lotus Labs has corrected 50%. A diagnostics has corrected 50%. So all the excesses are out of the system. Generally, when 5 to 7 year return is low, is a good time to build a small cap portfolio. So the long-term stance is very bullish. Strategy is to put fresh money at current levels and on dip. So we initiated a fresh call to buy and be ready to buy on the way up highs, on the way up about 2021 highs. So going forward a few months, a year later, we'll be ready to be aggressive even at higher levels. That is where technicals helps you. Like in November 2020, we were much more aggressive at 12,400 Nifty as well. Now, sectors to watch out for. Banks was an interesting opportunity in 2022. Now, I believe it should be a market performer. One has to be more selective. PSE stocks, X of PSU banks look very interesting. High dividend yields, low PE combined with long-term technical breakouts. So this is a good place where return expectations should be lower, but your downside risk is also lower. There are a lot of stocks which are in this PSE segment are hitting 10-year highs, 15-year highs. 2007, 2014 was the previous top. Auto index has a strong chart, but a better play could be auto ancillaries, which we look at. Capital goods trend continues to remain strong. Was our hiding place, but now outperformance may not be that huge. So one has to be selective. Defense stocks still look interesting, but selectively. So that is where we discussed a dynamic tag. There could be some more. Opening themes could have another leg up. We are seeing a lot of resilience in a lot of hotel names. They did not correct in the current fall, and they could surprise on the way up. Now the point is you got to be alert because the momentum phase could also see new prospective sectors. So example, post demonetization, we got real estate. So it was the best performing sector. So if you want to keep getting this phase, this is how you can how we can help you. So what do we do? So we run two services which could be helpful for you. First is what we call as technical traders room. So this is a service which is more, it is not recommendations per se, it is not a research service, but it is where we share a lot of things we are looking at. So because we look at 1,000 to 1,500 stocks on a regular basis, we look at a lot of alternative data. We are looking at insider trading. We are looking at bull deals. We are looking at fundamentals. Things are changing, etc. So there are a lot of potential setups. See, in the end, we are concentrated in terms of we may not take all the actions, but we look at a lot of data. So we cover a lot of setups which could be interesting. So it could be of a lot of help. There are no buy or sell recommendations here. We also cover index views, sectoral trends which are shaping up. So if you trade regularly and understand basic chart patterns, you're looking for setups. This is an extremely interesting service, pretty cheaply priced at 12,000 rupees per annum, 1,200 rupees per month and 11,000 rupees per annum. So if you can take your risk management, this is a good service. So we started doing this so that whatever we research, it keeps going back because we may not take because I look at the whole markets, the team looks at the whole markets. It's not, if you like banks, you may not want to participate into NBFCs, right? But there could be some NBFCs which are breaking out in 2022. So we share all which we are looking at. So for example, one of the reports which we came out in 2021-22 was Kirloskar Group, right? Now, the best performing stocks have come from that group because there was some change. There was family adjustment in terms of shareholding. They did a big analyst meet. So we came out with a note changing times. Very recently, we looked at value-added metal stocks. We came out with a note on banks in 2022. Very recently, we came out with say a small note on gas stocks, which could do well, and they've started doing well. Then there are interesting research. For example, we came out with this note on Power Grid, one of the only companies where FIIs have actually increased shareholding in the last 2 years, even though FIIs have been seller in the net markets and DIs have gone down. We saw this happen in an ITC also. The moment FII started buying, things started changing. So a PSU stock where 33% of the holding is with FII. So we keep sharing this information. We covered a company called Bharatwire Rope. So we also share a lot of management interviews, conclusions out of management interviews. So all the interesting stuff in this report. So you'll keep getting such charts. Now, the other service which we run, which is our flagship product, which is what we call as Technical Traders Club. So in this, we have two types of services. One is, which is part of Technical Traders Club. We give two types of recommendations. One, which is trading recommendations, which have a holding period of 15 days to 3 months, and a small cap folio recommendations with a holding period of long term, 6 to 18 months. We are focused on mid caps and small caps. You will get an entry as well as exit mentioned. It's a mix of technicals and fundamentals. So it's all our approaches techno funda. So it's a mix of both. And one of our core capabilities is to avoid terrible companies. So for example, you would have heard a tagline named Chor Bane More. That is a tagline which I came out in 2015, looking at companies which are changing governance. So I have a personal interest in understanding frauds. So I can claim to the fact that I'll be able to avoid bad companies better than catch the best companies. So our focus on fundamentals is to avoid companies where you lose majority of the capital and never come back. And that's the reason we can do better in small caps and mid caps. What not to do is where we are very clear. So if you're looking for positional calls, cash calls for longer term duration, this is a service. It's priced at 15,340 for 6 months, 25,960. All the returns and recommendations, if you want an exact, say all previous recommendations, how it worked out, the details, you can just email us or WhatsApp us on the number. So last year we did 18% on Traders Club and 24% on the small cap folio. Out here, you get entry and exits. So I would suggest look at our website, nureshtech.co.in. Keep following us on Twitter. Add on our WhatsApp. So every time we post something interesting, you'll get a WhatsApp. Just message on 7977801488, which is there on the website. You'll sit on my Twitter. You can just register on your email on nureshtech.co.in. You'll get an automated email every time a blog post is written. And say we have other services for derivatives. We have say Traders Room and Traders Club. We are also there on small case. In the last 1 year, I think we are in the top performing list in small case. It's a much more concentrated small case. It's top 10 techno funda is the scheme. We also come out with insider trading. So all the details are there on nureshtech.co.in. You can go through our older posts, which are there. I have more than 3,000 articles on the website till date. So follow us. You'll get a lot of more insight. We come out with a lot of free stuff as well. So it's not just paid. So follow us. If you like it, share it with others also. So that helps us. So this is where, like I said, at the start of the session, I'll be speaking for 1 hour, 1 hour, 30 minutes. Exactly at 1 hour, 30 minutes, I stop and I take question and answers. So you can put the question and answer in the chat box. So I'll take the Q&A box first. I think we'll be able to, we'll be sharing the recording ideally on YouTube as well. I have 2 questions. Do you have any PMS service? No, we are a research analyst, this thing only, but we have a small case. This thing we can say customized research for you, so you can get in touch with our number. What should be the ideal cash ratio now, or we should be 100% invested? So we've been 100% invested for the last 2 years across the cycle, from 2021, 2019 to 2023. We've barely been on cash. I think some part of 2020 we had small cash, and we've still done well. We've actually initiated a fresh initiation of equities on 29th March. So that's the last call. So 100% invested. The only time we want to increase cash is when we see that huge small cap divergence we saw in 2017 and 2007. Apart from that, one can digest a lot of cycles. So as of now, yes, 100% investment. PSU banks outlook and your best pick in the space. So PSU banks is a tough space. The smaller PSU banks in terms of market cap are pretty large. So I came out with a note right at the top calling out PSU banks. They may look 60-70 rupees, but they're 50-80,000 crores of market cap. So small cap PSU banks, I'll be careful. The largest one, SBI, looks the most promising because that's a stock which has done nothing over the last many years. The longer term charts are more interesting. So my viewers in PSU banks, focus on the first top 3 names. The next threat for market and underperforming sectors. So the problem is a lot of underperforming sectors have already underperformed. Now, my view is the underperforming sectors will have select names do well also. So you could have a case wherein an IT stock is at a 52-week low and another IT stock is at a 52-week high. So do not take sectoral calls in this time in terms of sectors which have taken a hit. So be stock specific in IT, pharma, specialty chemicals. Can you please make one small case on technical trading room with free structure as well as you've done? So the top 10 Techno Funda has almost the same ideas as our technical traders club. We created a small case for the people, those who wanted automation. And it's very nicely priced. I think we should increase the cost of the small case rather than create more small cases. What's your view on Adani companies? It is okay to have no view. So I don't have a clear view on Adani companies. And this is one company where sector where there is very low allocation from institutional side. The volatility is very high. So it's not necessary to have a view on the markets, not necessary to have a positive or a negative view. There will be selective opportunities. So if you would have heard me on TV, in the Adani companies fall, the only 2 stocks which I said could bounce back were Adani Ports and Ambuja Cements, and they've done well. So the view is no view on Adani Group. Gap up, gap down में कौन सा strategy लगाया सर? So gap up and gap downs are part of the market. You cannot help it. If you were trading 24 hours, gap up होता ही नहीं. So the view is gap up, gap downs are part of the markets. There is no strategy for specific. You have to understand the trend and accordingly the strategies are. Do we have any service on option selling with proper hedging terminal losses? No, we don't. We don't look at option selling as such. How do you track sector rotation at an early phase? So if you want an answer for this, luckily there is a very, a video, a course on upsurge.club, which I've done. It's priced very cheaply. I think it is too cheap to be actually given at that price. So where I talk about sectoral rotations, so you can look at it. Plus I have a few articles on nurejtech.co.in. I think that course is priced at 500 rupees. So you can go through it. Where I take this sector rotation part. We've also done webinars on that specific topic before. View on CNX Realty and Realty stocks. This is a tough sector, but the recent price action is very interesting. The last 1 week has seen a lot of price volume action in a lot of real estate stocks. So we are actually studying that. We've not made a clear view, but that's a sector on our radar. Any views on Reddington? That's a stock which has underperformed our expectations. We used to have a buy call and a year back. We sold off around the entry price as such. So we don't have a view right now. Technically, it's a little oddly shaped. Which sectors you're mostly bullish on? So I've discussed it. Capital goods is where we have allocations. We have on opening up theme. public sector enterprises. Then there are selective stocks. Rest, anything new which comes up, we try to post it on our traders room as well as on traders club. So as of now, these are the sectors we are bullish on. We are more stock specific right now. How to find turnaround sectors, stocks and sectors. So turnaround is a tough thing to catch. Most turnaround stocks do not turn around as easily. So we wait for price action also. So turnarounds are more caught on earnings change, etc. But we use a mix of both. So for sectoral, like I said, there's a huge, there's a good 2 to 3 hour webinar I've done, which is there on our app as well as on upsurge.club. You can go through it because it takes a detailed understanding. What's your view on the IT sector? I think the IT sector saw a leg of huge outperformance in 2021 that is over. And if you look at the history of the last 10, 15 years, it has always been a market performer. IT as a sector has not been a major outperformer apart from 2021. And that is the view. Going forward, it will be a market performer, but one has to be very, very careful here. So you'll have a case wherein the Wipro is making 52-week lows, a KPIT Tech is making 52-week highs. So it's no more a call on a sector. One will have to take stock specific calls. So going forward, a large cap could be up 30%, another large cap could be down 20%. So be stock specific on IT sector. And that is where, say, when we don't have a clear sectoral view, we don't want to participate as much. So we have zero allocation to IT, and maybe for quite some time it would remain the same. In one of your videos, you talk about custom indices. I face one issue. There are so many. Do you follow any criteria to include? So the way we include, we start making small cap indices is, say earlier, say the classical ones are sugar, paper, metals. Say, for example, now it is value added metals which were hitting 52-week highs. So we start making custom equal weight indices once we start seeing something. So a lot of indices, a lot of sectors, subsectors are not there on the indices. So you don't need to make an auto index, right? But you can make an auto ancillary index. So what we do is, one, we already have quite a few made. The rest we make as we see some trends in a few stocks. So 2015-16, we started seeing mills making new highs, so we make a sector. So today we've started tracking sugar because sugar prices have hit a new high. But sugar stocks have not, so that is a sector which we are watching. So that's how we start making custom indices. How do you see the recession and its impact on the market? So you can go back into history, try to correlate when the recession numbers start coming in and what is the index. So the markets tend to take the impact much before the actual numbers come in. So that's how it is. So I prefer to look at things which I can understand. I don't try to understand or make a macroeconomic view. So my view is very simple. Markets are ahead of time in terms of macro impacts. See, once the impact is done, the markets takes a hit very quickly. So recession is something which has been talked about for the last 1 year. The market gets hit by things which are not known. So COVID was unknown, and that is what hits the market more. So I'm always worried about things which are not there on the horizon rather than which you already are hearing on the news. What is your view on Infosys? No clear view. The stock is not holding on to the recent lows. The stock held on in the previous month thanks to the buyback. So no clear view on Infosys. It actually breaking 1400, 1350 would be a bad indication, which could be possible on the next on Monday. So no clear view out here. Small cap index investing or direct stocks, which one you recommend, as it might take time for constituents in index? So we don't have, see, the problem with the indexes, you cannot be invested in BSE small cap. It has 700, 800 stocks at a time. Nifty small 100 ends up seeing a lot of crazy companies becoming a part of it. So index investing in small caps is avoidable. You could either take the small case route or mutual fund route, that is better, or go direct stocks. And it cannot be a large, say 100% of your portfolio unless you are comfortable with the drawdowns. So you can decide whether it has to be 20% or 80% of your portfolio. But the approach should be in small cap investing, it cannot be index. It has to be either direct stocks or a mutual fund or a small case. What's your fundamental view on the petrochemical sector? I don't really track the sectors to have actually a view on it. Your view on Alco Logistics, the stock technically, as I see it, it is pretty sideways. So as of now, it went through a huge rally. Now it is sideways. So we'll wait for the price action to change. So do holding stocks for lifetime works? It does not. Right. It is only luck. In the long run, it's only luck. So if you were to look at it this way, the only thing which works on the lifetime is the fact that survivors do really well. So you could take a long-term portfolio, 10 stocks equally weighted. 9 of the stocks go zero, and one stock becomes a 100 bagger or a 20 bagger. Your return is still going to beat everything. So holding stocks for a lifetime works if you do not sell any of your stocks and you get lucky. But the problem is most of us tend to sell off the stocks which do well. So I believe one has to have a more active approach. The markets have become more and more dynamic, and they're not, say, inefficient as they were in the 1980s or 1990s, wherein CCI came up with how the IPO should be priced. So the new stocks no more are cheap; they come out expensive. So my view is holding an index fund, a mutual fund, a small case, or a PMS for a lifetime would work better, because somebody out there is trying to do an effort. Any 2-3 sector which is an avoid clearly from tech or fundamentals also. Are you still negative on chemicals? So my view is a lot of these sectors which I was extremely bearish on have corrected quite a bit. So specialty chemicals, pharma and IT, which I spoke about last year, or rather in 2021, they've already fallen 20 to 50%. I'm still not positive on them. So my view is one has to be selective, because in all these sectors we'll have one stock doing really well, 3 stocks doing bad. So I'm still not gung-ho on IT, pharma and chemicals in a big way. I'll be selective. As per healthcare department, COVID will start falling in 10-15 years. So pharma is very, very selective. It's more like a trade, not an investment as of now. So for example, if a Dr. Reddy's breaks out at 4,600, you take a trade for the next 15%. Not very comfortable taking an investment call on pharma, because what we see is when a sector tops out, it takes a really long time, right? Sun Pharma topped out in 2015, 8 years have gone. Lupin, 8 years have gone, right? So for example, we looked at ITC, 2013 to 2020, it was an underperformer. There were periods of time which it did well, right? So one has to be careful. Pharma is a trade as of now, and it's a very difficult sector to understand. So I have zero understanding on the sector as such. Because an FDA can come out of nowhere. What is ANDA? What is formulations? Even the best of the healthcare experts do not understand. But we as retail investors want to think we know all. Do you see 2024 elections overhang for a major rally plus global disturbances on? Again, like I said, there is over information and over access to information, which creates a problem. So elections do not matter as much as we think. So I would say go back to my report. I came out with a report in 2014 elections. Indian elections, do they matter or do they make an impact? I'll give you a very simple example. I'll take the last few elections. 2004 elections, 17th May 2004, Black Monday. My initiation into the markets was 2 weeks before it. We got a lower circuit in India, but very interestingly, 17th May 2004, every market in the world was negative on that day. Most markets had a 2 to 3% fall. I don't think it happened because BJP lost. Right. So, and April to May 2004 was a negative return for majority of the global indices. I don't think it happened because of Indian elections. So 2009, we saw an upper circuit on Indian markets. Congress came in with a lower majority, but it got an upper circuit for 2 days. But before elections of 2009, Indian indices were lagging by 20-25%. The trend was still up. So we did a major catch up. But if you were to take April 2009 to June 2009, we ended up being a similar return. So my view is what really matters is the global conditions rather than the elections. So if there is a China-Taiwan war, that will be more important than a 2024 elections. And we don't have a clue on that. So let us not go to things which we don't understand. So you can look at that report 2014 going into elections. I was 120% long. We discussed it in March, April, came out with a note. It is there on the website. You can read it. It will give you a good understanding because we've compared various markets around elections. So 2004, 2009, 2014. Which sectors you are most bullish on? So say we don't have a clean, apart from the 2-3 sectors which we spoke of, capital goods, defense, then there is opening up theme, and then there are very selective stocks. So we are not taking, we don't have a 5-sector approach as of now. So we are more stock specific right now than sector specific. We were very sector specific last year. So as of now, the view is few stock sectors which look well and find new sectors, but be more stock specific. Best small cap and mid cap mutual funds for the long term, according to you. So I don't track the mutual fund space very closely. I had been on the institutional side as a technical research head. So I will have had interactions with a lot of small cap and mid cap mutual fund managers. And it's all cyclical for all of us. So there will be a time where a small cap fund manager will be in the top quartile. So from seeing stars to becoming seeing stars, becoming a star to becoming a seeing stars in the day, you get a hit very naturally. So viewers, do your research on the small cap and mid cap mutual funds. You have to understand the fund manager and the say the fund house process, and then take a call. I am not a specialist on it. So my view is to go stock specific. I would instead suggest to subscribe us for the small cap and mid cap. Do you wait for retest of or allocate 100% at breakout level? So I'm more focused on as a trader and an investor, our focus is to allocate more right away on the breakout level, because you don't know whether there will be a retest or not, right? So the whole point is you don't want to miss out on a big opportunity. So more focused on allocating right away and add more on the retest rather than keep holding on. Do you take a macro view also? Does inflation? So the point is you take a view on everything around the world and then try to compare price action. Do you feel FII will come in now since they hold the most ammunition and previously without them Nifty doesn't make new highs? So I would suggest go look at, I'll give a very simple comparison. So today the market cap of India is 250 lakhs to 300 lakh crores. FI is on 20%, DI is on 14 to 15%. So please do not consider the domestic inflow to be inferior to FIIs. So the fact is the domestic inflows are creating a better base to digest a lot of FII flows. FII flows will create the momentum. DII flows will take care of the drawdown. So we are in a very beautiful place in that case. So my view is look at everything around the world, mix it with technical analysis. That helps us the best. That's how you can actually be able to call bottoms in 2000 various cycles which we've done, because technicals helps you do that. So macro is something where you can get very, very biased. So if you have a political leaning, you can get very biased. So the viewers use all what you read, but try to focus on technicals also, because markets give you the better answer. Price action gives you a better answer along with it. So my view is structurally very positive. Fundamental recommendation, positional. So like I said, we do a mix of technicals and fundamentals. So the first focus is to avoid terrible companies. So That's how we do the first screening. And second is we look at majority of the companies to be decent on fundamentals. We avoid terrible companies. Your favorite pick in defense, I've discussed one in the webinar, and there is one more which we've not disclosed, and we are watching the sector. What to do in Infosys is it opens at a lower circuit. It's not necessary to do anything. If you have a position, if you had a long position and you had a stop, and what was the logic for going into a long before the results if you're a trader? Because as a trader, if you do not have a view on the result, and technically there was absolutely no reason for long or short because it is at the same place. And if you've still taken it, you have a stop loss in place, be disciplined. Whether it opens 10%, recovers 5%, you have to stick to your discipline. That is how trading has to be done. How can we subscribe to your mailing list to get blogs? You can just go to nurejtech.co.in. You'll get an automated update or you'll see it on the side. Can you answer this? Make a small case on technical trading room with fee structure the same as top 10 techno fund. So see, the technical trading room, we have everything we track. So from everything we track comes to the part on things which we are doing. And that is where the top 10 techno funda and the technical traders club come in. So traders room is something which gives you all the insights and you have to decide what you want to do. So for example, to simply put, if I'm sharing 10 things on traders room, I might be doing 2 to 4 out of it. Because you can't do it all. How to use relative strength to identify exact turnaround points? You cannot find exact. That's the first thing you have to understand. So what you need to do is use relative strength along with price action. So for example, let's take 2020, pharma stocks fell the least. So first indication came from relative strength being higher without the price fall. Then pharma stocks were the first ones to hit 52-week highs. That is where you get the momentum part. You cannot find turnaround points using relative strength. Relative strength allows you to find outperformers more than turnarounds. So we use relative strength to find outperformers rather than bottoms. In small case, do we go cash in bear market? So the only time we want to go in cash is, and that too, I will never go 100% cash ever, because that's a huge call to take and the mistake could be terrible. Like I said, 2021 to 2023, if you took a large cash call, the index is at the same place, but still there was 20 to 50% return to be made. So only time we'll take a 20 to 40%, say even max 50% cash call is when we see a small cap divergence. We saw it in 2017, 2007. Till that point of time, we don't go on high cash. Because majority of the momentum portfolios go on high cash on the way down. And no offense to the momentum trading side of it, but a lot of momentum trading portfolios got lucky with COVID because there was a quick fall wherein you went on cash and the recovery was faster. So there was no whipsaw. So you sold at, say, a portfolio from 100 to 90 at 90. It went to 60 and you got back in at 70. So you made a 20% alpha by the in and out, which may not happen again, maybe for a long period of time. So that's the way to work. The whole point is, if you can outperform the markets without going into cash, isn't that interesting? What are the features of technical trader room and how it works? We've given the whole, I just spoke about it, the details. I would not like to repeat, but the whole details are there on the website. You can just search for it. It's a place where we share a lot of insights. On KMC specialty and hospital. So I don't track KMC very closely, but Mrs. Bector has been in a strong trend of late. Your view on HDFC Bank, like I said, that could be a stock which could surprise on the upside. Dr. Reddy is a short-term breakout. What are the features of technical trader Zoom? Like I said, we share all the interesting chart setups. We share interesting things which are happening on insider trading. There could be a bull deal which could be happening. There could be a management interview which is interesting. So we keep sharing whatever we are looking at in terms of insights, any sectors which prop up. So it's basically all we are looking at in terms of important stuff which we share. So and it happens during live markets as well. So that's the basic way to look at it. Details you could read about View on Dharti Dredging, no idea on that company. I think it's a new one. Z Entertainment, this is a stock which will come on our radar from tomorrow after the big block deal, and then we'll see price action because one of the dominant holders of the stock is going to get out. So now we'll wait for the price action. Z was one of the, for me, was a big winner in 2021-22. So again on radar. Vatek Wabag is an interesting chart which looks promising if it can continue and follow up with the breakout. Thanks a lot, Kamlesh, for your kind words. How to invest, where to invest for regular income? Can it be monthly or quarterly? The only way you can make regular income is via fixed income, liquid funds or debt funds. You cannot expect a regular income from trading and investing in equities. I think I've covered how technical trader room works. Your view on Nifty, it will retest recent low violet. So our viewers, we may not definitely not break 15,200. A retest of 16,800 would be fine. Your favorite good pick in capital goods and PSC. So capital goods is something where we are holding a lot of few stocks. For example, we used to own Sunvi Movers. We've sold out recently. So capital goods, we may have a positive view today on a stock, but we may get out for relative opportunities. So my view is, as of now, hold majority of the companies, but at some point of time, there could be a relative better opportunity. In PSCs, I've clearly said Power Grid is an interesting place. NTPC is one. But again, you have to be very patient with them and do not have crazy expectations. Please share views on Reliance Industries. So 2180 to 2300 is a strong support. Till the time we are above that, the trend looks okay. But technically, we are watching once it can sustain 2450, that would be a time a trend change has taken place. NDR Auto, I don't track very closely, but an interesting company. In small case, do we recommend company under Nifty 500 or any such criteria? So we don't, we are very agnostic in terms of criteria. So we may recommend an Indian hotels also at time and a small cap hotels also at time. We may have a 400 crore market cap company also in 40,000 crores. So anything which looks interesting. So we don't have a criteria per se, which company, but we are open to everything which is liquid. Thanks a lot for your kind comments. Would you stake the probability of bull market is higher than that of bear market, which is likelier? So like I said, the view is very clear. We are still, we are not in a bear market per se. We've not corrected a lot. So this is a sideways bear market, which I spoke about, explained it in detail. So the view is over the next 6 to 18 months, sometime, a bull market on it. We don't know. So the view is, we might have, the one thing is which is clear, we've already seen the worst. That's my personal view. Thanks, Yogi. Yeah, Shivaji is one of my older students. Maybe I think it's almost more than a decade, or maybe 12, 13 years back. View on Guinness Power on radar, but the stock has not broken out. So I think I've taken most of the questions. Thank you all. If there are any questions, I think there are some on the chat box. I'll try to take it in the next 10-15 minutes. I took it from the Q&A box. Let me just see if I can take anything on the chat box, which is not repetitive. Adani, no view. Arvind and ITD. Arvind seems to be bottoming out. Indiabulls Real Estate and Indiabulls Housing. I think Indiabulls Real Estate at this price is worst is over, but when does it get into momentum is difficult to say. Very interesting at these prices, but a very high risk bet. Will there be a one big down leg in this bear market? I don't think so. So how can we play this charts on index? Again, the same way we look at technical analysis, positioning. So you look at various chart patterns, like we looked at Bank Nifty in June 2022, you can get such opportunities. So I don't want to give stock specific hold or sell, but I do like Power Grid. What is your view on paint and real estate stocks? Paints is something which is an avoid for us, too expensive. too much competition, not the place you want to be. Real estate is something which has come up on our radar. Watching it closely, the first move is done, whether it can get into a new cycle. View on pharma and diagnostic companies. I think the worst is over for diagnostic companies in terms of price action, but not the best place to be. So it's not necessary for me to be participating in all the sectors. Changing world order, so many demands. World order on IT companies and so many got closed or non-functional. Your take. We keep seeing demat accounts are not closed or non-functional in a big way. So IT as a sector overdid the move. So now we can expect consolidation and very selective moves. How do you think US markets will affect US markets bottoms after Fed pivots? I think this is where you're wrong. US markets, you can look at it in terms of price action. Fed pivot is rather more risky than a cycle. So the best returns have come when the Fed has been increasing rates and keeping it flat. KMC, no view, paper sector and packaging sector. Packaging is interesting. Paper is classical, cyclical, got to be careful. Bosch has seen a short-term breakout, but the stock does not follow up a lot. Adani, no view. View in Nasdaq versus S&P 500. So we came out with a note a few months back saying the whole cycle of Nasdaq is over and now expect Dow and S&P to better, and it did better in the near term. Focus more on say Nasdaq is something which I would avoid the whole say new age companies, but be selective in that. So out of 10 companies, 8 may do bad, but 2 could really come out really well. What's your view on DMart and Asian Paints? Too expensive, technically nothing interesting. View on WPL, I think in the near term it is overdone. Nesco, there is a concern in terms of how the sector would do going forward. Water theme is interesting. Sunrise sectors, pharma has bottomed out. Short-term bounces, yes. Short-term trades, I don't think long-term could be a big one. One has to be very selective. Water theme is interesting. We are watching out. Vatek Wabag is on our radar. Can we enroll for Technical Trader Club on monthly basis? Not really. I would prefer only annual. We've kept 6 months also for people to try, because it's not something where a return can come on 1 month basis, and there could be times there is 0 recommendation for a month. So why do you pay me for that? Right. So we are not a day trading organization. Any discounts on your pricing for viewers? I don't prefer to take the discount route as such. We keep our prices pretty low. We rather want to increase prices, but I think most people are not ready to take increased prices. So we keep our prices pretty low. Any view on Tata Elxsi at this point? My view is it's just too expensive. It's at 10-15x sales. So one has to be very careful. IOL Chemical technically could have, it's a bounce back trade. Long-term view on ITC now, I think the good part is over. Now you have a market performer, nor an outperformer. Will you share the recording of this session? Yes, we'll be doing that. I think we took this in small case. Do we get Everest Kanto? Very bad pass, so one has to be careful. Difference between Traders Room and Traders Club. Traders Room is where we give insights. It's not recommendations. It's not a research service. Traders Club is where we give stock-specific recommendations. How to manage stop loss in such volatile environment? I just don't understand where is the volatility. The fact is we've not been volatile as we've been in previous cycles. There used to be a 10% weekly move in 2008. There was a 40%, 30% correction in 2006 in the middle of a bull market. In the last 10 years, we've not seen a volatile environment in terms of big, large corrections. We've not seen a 40% correction apart from 2020 that happened because of COVID. So I think relatively we are in a much lesser volatile environment. It's just that one has to accept the volatility and it's part of our life. Is the large cap service? So we do not have a large cap service specifically because we are agnostic. And the fact is, we've seen on the down cycle, large caps also fall the same way. So small caps on the higher end do well. And in our strategy, we are able to avoid terrible companies in the small caps. And that's the reason we focus on small caps and mid caps. But in between, we do come out with interesting, say, presentations. So we came out with banks in 2022, which is the largest sector in India. What's your view on Eastern strong trends technically? So, when do you think Fed pivot will come? I don't think I can answer it. I am not capable enough of it. But my view is rate cuts are more risky than my view is a flatter rate condition, a more certainty would be better. Show, sir, please, free recommendation stock pages. I keep sharing a lot of data on our Twitter handle as well as on the website. Is Suzlon can become multi-bagger? Like I said, this is the obsession of buying single-digit stocks. So Suzlon is something which is a fallen angel, not necessary to make a view there. Which sugar stock to be invested in long term? I think most of the sugar companies which have survived are decent, but if the cycle plays out, there are many of them. Quantum small cap funds, I don't have a stock specific view. NIIT, the chart is interesting. We just posted it on Traders. So small cap ETF, I don't know of any which could be that interesting. So I think I've covered most of the questions. And if you have anything, you can always send us an email and WhatsApp. I think I've done the time 11 to 1. Thanks all for your kind comments, and please do like, share, retweet. Please elaborate about your paid services. Like I said, I generally don't like to market ourselves. At least in this webinar, I've spoken 5-10 minutes on our products. The best way is we give all the details on our website on our paid services. Rest, my personal phone number, Harsh's phone number, our WhatsApp broadcast number, all there on the website. So if you have any queries, you can always get back to us. I'm really sorry. I think I'm over time. If you have any questions, do send us an email. We'll get back. Thanks a lot, everyone. I tried to take as many questions. I'm sorry for questions which I could not take. But you can send us an email or WhatsApp on our broadcast. We will always try to get back whenever we have a view. And please go through our website for all our details, and keep reading the blog post. I try to write as much as possible on a regular basis. Twitter handle, which is Nuresh Tech. You can follow us. You can follow us on. We are there on all social media, whether it is Instagram, YouTube. I think I'm there on YouTube. The first videos in 2008. Not very active there, but we'll try to put this session on YouTube. Thanks a lot, everyone. If any queries, all our details are there on the website. Thank you so much. And we end the session here. We don't have a coupon code approach here, Pushkar, so that's a problem. I don't really understand giving discounts. I would rather keep our prices affordable. Thanks a lot. So this is where we end the session. Thank you, everyone. Do like, share, recommend. All right. Let me end the session. Stop share.